Hi everybody. This is Meherban Faroogh from the Thousand Pip Club. Today, so first of all, I was hoping we'd get our regular trade plan. That's the whole purpose of our Wednesday classes on FX Street, which we hold at 7 a.m. Eastern, which is actually 12 GMT. So once again, Demi on the side, she can guide you where to post your trade plans, and I do appreciate early days. It takes a little while for people to get used to it. So be very patient. But in the meanwhile, we'll keep bringing in topics to these classes that are meaningful, that are the current market conditions, something you should keep your eye on, so on and so forth. So anyways, since I didn't see any plans on the forexstreet.net site, I had about an hour in the morning, so I created something quickly that I feel people should be aware of. Last week, I did a class, I think it was last week or week before, I'm not sure. We did a class on the sovereign debt crisis. Since then, S&P has downgraded, as you all should know by now, on Friday, Jan 13th, 9 of the 17 EU nations. The only significant one they left out was Germany. But from France to Italy to Spain, and some of them got downgraded 2 notches. So we talk about that a lot when I do my trade plans, or when I talk about currencies. We talk about bond yields and downgrades and risk on and risk off. So I thought for those of you who are not completely the same page, I thought it'd be helpful if I take use of this time today and kind of explain that a little bit more. And I think that would be helpful. Before I go into the slideshow, let me just go back to, so just reminding folks, for those who are interested, we have a 1/3 special, New Year's special, that's available till February 3rd. We also have an open house for you to come and look into our site. No bars held for 1 hour. We had one last week on Saturday. We had a good response there. And this coming Saturday is the last time we're doing this offer open house. So when you click on the Thousand Pip Club New Year Special, you can go and read the details of the program is, and the instructions will be there. So whatever the instructions are here, just read them, follow the instructions. You'll get a link, I believe, from our webmaster. It's all automated. And for that 1 hour, which happens to be 10 to 11 a.m. Eastern Standard Time. So you can convert that to GMT. I think that's 3 to 4 GMT on Saturday, if you want to check it out. Okay, so with that, let me get started. Just a quick check once again. Do we have anything here? I didn't see any trade plans. If I just go, so guys, this is where you should put your trade plans. I'm glad last week Mark Knight did a great plan on Aussie US, and if I have some time at the end, which I think I will, I'll bring that up again, and we'll see since last week how did it behave, where did it go, where is it currently, so on and so forth. So if there's nothing else, so right there you go in groups, and this is not, by the way, this is not fxstreet.com. This is forexstreet.net. You can go by most active or latest activity. And on the latest activity, I don't see that right up there, which means there's no recent currency treatment. So you would click there. You go down the discussion forum under trade plans right here. You can pick up my template that I have placed there. You can look at what Mark did last time, but pick up that blank template and fill it out. And I don't get any pair. Just pick up any one of the 28 pairs. So we talk about the 8 major currencies. Euro, Aussie, CAD, whatnot, Kiwi, Yen. So a combination of those 28, any 28 pairs, pick it up. Just try and make sure your plan is current. So if you did a plan like a week back or 3 days back, that may not be relevant any longer. So as long as you take an effort and do it like 12 to 24 hours before the class and put it there, I'd be more than happy to guide you. Okay. That's my other thing. Just a quick sound check. Am I still coming in okay? Before I start, just to make sure I'm not talking to myself. Okay, Matt, can I get a quick sound check? user in, and his or her name is 1.4718. 4718. That's very interesting. That 4718 was, I remember, a strong euro number. Am I right? Whoever this person is, 1.4718. Is that based on the euro USD peaking out a few months back? Correct. I'm sorry. I find that funny. That's pretty cool. Okay. All right. Let's get to the point. Okay. So today's class, I thought, and I do apologize. I didn't get a chance to prepare this last night. I did this in a rush this morning, but I think I kind of captured most of the points that I want to talk about generally. That would be of good use to you, good use for your time. So what I want to talk about a little bit is about the rating agencies and how their rating upgrades or downgrades affects the yields specifically, and what that has to do at all with Forex or risk. And that's kind of the idea. So I actually saw a headline today on Bloomberg, and that's kind of what caused me to bring this up today. I don't think that Bloomberg really is about our rating agencies losing respect, but it's more about S&P. So I kind of wanted to kind of lay it out there and kind of share my own thoughts on the subject, right? So there are three rating agencies. We know three major rating agencies. I think there are quite a few actually. There are quite a few small rating agencies, but the three top ones are Standard & Poor's, Moody's, and Fitch Ratings. Now, before I kind of go on, just a little sidebar conversation. And again, there's a good book out there by Nouriel Roubini. I believe it's called Crisis Economics. And there are many good books out there. But this is the one that I kind of read through twice, if I recall correctly. And he goes into a lot of detail explaining the contribution of these rating agencies on the subprime crisis of 2008. And I don't want to go off topic here, and I don't want to bore you guys, but I think it's interesting to understand the role that they played. And not to downplay the value that these people offer, and over the years they've gained significant influence. But the point I want to make here, you'll notice on the fifth slide, or when I talk about the ECB chairman Mario Draghi, or the Bank of England chairman Mervyn King making some statements, that you can kind of see from that perspective how it all kind of ties in. And folks, I have to say this again, this is my opinion. And every day when I trade in the market, every day when I read stuff, and I read people's opinions too, a lot, and I kind of form my opinion. So you have to form your own opinion. Just be patient and listen to what I have to say. So for 2008 subprime crisis, which basically started from the Glass-Steagall Act being repealed. The Glass-Steagall Act, which was formed after the Great Depression, blah, blah, blah. I think it was the Clinton government that repealed that. But the rating agencies also played a major role, right? And this goes to them rating investment grade, AAA, whatnot, CDOs, credit derivatives, CDOs and CDO cubes and CDO squares, and all kinds of derivatives and derivative instruments, which led I would say naive investors at times. I would use the word naive at times, but investors to buy into those CDOs. I also understand that these rating agencies, they also had a consulting arm within their own units that consulted, the Morgan Stanleys and the BOFAs and the cities, whoever were issuing these CDOs before they issued. These consulting arms of the rating agencies actually advised these issuers of CDOs as to how can they structure their CDOs to get AAA or AA plus ratings for those very CDOs. So anyways, so they played a significant role in that sense of providing very lucrative rating to not so lucrative instruments back then, right? And that's the last decade, and then we all know the rest is history. the housing market peaked up 2006, came crashing down 2008, so on and so forth. And since then, March 2009, the equity started going back up, so on and so forth. So now, kind of fast forwarding from there, last year, S&P took a very bold stand and downgraded. And again, don't want to give my opinion it's right or wrong, but considering that US has a huge debt outstanding, which is 14 or 15 trillion by now, and that does not even account for Medicare and Medicaid. And if you add that number, that goes kind of into, I think it's 100 or 200 trillion, something ridiculous. But the point is, they did downgrade US. They stripped it off its AAA rating, but still, a week or 10 days later, US being the safe haven, US dollar being the safe haven, and US being the most powerful nation in the world, was successfully able to raise its 10-year treasury bills at even a lower rate, 1.6% or something like that. So that's a little background. Rating agencies in the current times are very influential. And if I was Mario Draghi, or if I was Mervyn King, or if I was the Federal Reserve Chairman, Ben Bernanke or whatnot, I would not like to give so much power and influence to credit rating agencies. I would like to downplay them personally. I would like to do that. And I would like to take away their power. That's what I would like to do. And I would take opportunity of, just like as Forex traders, you take opportunities of retracements and try and take pairs long or short, depending on what you think. I would like to take opportunity of situations in the market like what I'm about to talk, where it comes across as if the market didn't listen to them, sure, and they didn't, and try and play them down. So that's kind of my little perspective. What I'm talking about, or what I'll cover today, I have to be upfront. It has nothing to do with giving you a precise price point to enter or execute a trade, and I have to be very clear on that. So, and that goes a lot, and I say this because over the last few years, as I've been learning myself, and if some of you are struggling and trying to figure out, yeah, all this is great, nice and dandy, but how does this help me to trade Forex? This is the big picture. Okay? This is the big picture I talk about. The big picture fundamentals, the big picture what's going on, the big picture you need to keep in the back of your mind, and then assess what's happening in the current time frame. When I say current time frame, I mean whether it's a technical charts, right, on your 60 minutes daily chart, 60 minutes or 5 minutes, or whether it's in the current time frame. Spain's issue failed, or Spain did a great issue on bonds, or whether it's the home sales data that came out or non-farm payroll that came out. So under the current time frame, what you see on your charts, under the current time frame, what you hear in the market, and then keeping that big picture in mind, whether it's big picture on fundamentals, right? Sovereign debt crisis, rating issues, growth issues, you name it. Or it's the big picture on the monthly, weekly, and daily charts. So kind of you have to look through all of that and try and identify decent, precise, I would add, decent, precise price points at which point in time you'd like to get back in the trend. So you're essentially waiting for a retracement to get back in the trend at decent price points. And then you use parallel inverse for that and a lot of other things. So that's a little upfront heads up. But coming back to the point, so there are three rating agencies, three significant rating agencies that are very well respected out there. That are still quite a few on the side that don't have much influence, so to say. So generally speaking, when these rating agencies give, and whether it's a corporate or whether it's a nation, doesn't matter. So generally speaking, when the rating agencies raise your rating, let's say from a AA plus to like a AAA or something, you should expect when it comes to bonds, what that means is, from an investor point of view, is you can take on more risk. So if you can take on more risk because of a better rating, you, the investor, is willing to buy that bond at lower yields, at a lower coupon rate. That's really what it is. Now, to get a little bit more technical, in terms of price, the price will go up, right? Because you'd be willing to take it off somebody else's hands. So the demand goes up. When the demand goes up, the price goes up. So in very simple terms, not to confuse too much, but and I say this because if when you read the news, kind of you can quickly relate that together. So when you see the bond prices go up, its yields goes down, right? So when the demand for bond goes up, the price of that bond goes up, whether it's a Spanish bond, whether it's a U.S. Treasury bills, or whether it's Citibank's corporate bond, whatever. When the price goes up, the yield goes down, and that has to do with good ratings, generally speaking. Now, so when the yields go down, essentially risk is off. So when risk is off, in whether it's for that given period of time, couple of hours, a day, days, or weeks or months, depending on how far the risk goes off, you can buy risk currencies. So a risk currency essentially is one which has high yields at this point in time, right? Or essentially like Euro, Aussie, Kiwi, like that. Now, on the flip side, once again, bad ratings given by these rating agencies generally would result in higher bond yields, which basically is because of people wanting to sell the bonds that they're already holding, or if there's a new issue coming up, and again, I mentioned this in the last sovereign debt class, and I'll bring it up, that slide again at the end. There's a lot of debt. There's a lot of debt that needs to be issued to refinance by the EU countries, like Italy. That is like 1/3 of the entire obligation that EU nations have. So I'll bring that slide up at the end, but the point is that there's a lot of debt that needs to be issued till end of March and for the rest of the year 2012. But when there's bad ratings assigned to these countries, as a whole, you would expect the bond yields to go up, or essentially the demand for the bond itself for that particular country or nation to drop, essentially falling prices or rising yields, whichever way. Now, when that happens, your risk is back on, and when risk is on, typically the market will sell risk currencies. Now, the other thing you should keep in mind is these risk currencies, not 100% is not 100% correlated, but there's a very strong correlation between these risk currencies and the equities market, essentially Dow and S&P. And you could almost put up a 5-minute chart, and if you followed the Euro USD, Aussie USD, Kiwi USD, and let's say the Dow, or S&P, you can see them going in lockstep together, which is why support resistance and fibs on even equities makes a lot of sense. So the point here is under the current market conditions, based on what we've seen since Friday, is it only and this is the question I'm asking, is it only the S&P, Standard & Poor's, that's losing respect, or is it the entire industry that's losing respect, as Mr. Mario Draghi or Mr. Mervyn King would lead you to believe? Okay. Now, so let's look at some bond auction results. In August 2011, S&P stripped USA of its AAA rating. We all know that. And then 7 weeks later, US issued its 10-year Treasury note at a record low of 1.67%. The market was surprised, and if you're following the news, from CNN to CNBC to whatever, there's a lot going on at that point in time. But the reality is that US dollar is a safe haven. US is still one of the most powerful nations on the earth, and when things go wrong around the world, people look at the US, to call the shots, which it does most of the times. So the point here is, if US was stripped off its AAA credit rating, and risk was off, U.S. Treasury bills or Treasury notes still happen to be the safest instrument on the world. Would you buy Chinese bonds? Would you buy Japanese bonds? Would you buy Euro bonds? Or would you buy U.S. bonds, U.S. Treasury bills? Which ones would you buy? Right? So now, that being said, over a longer horizon, I honestly don't know what's going to happen, because the fact remains that U.S. is in a massive hole. In my opinion, if and when the dominoes start falling, when the sovereign debt crisis bubble bursts, just like the real estate bubble burst, right? It reached a peak in 2006 and 2008 started crashing. So when that bubble burst, and I said this many times, I'm going to say it many times again, you saw a crash happen. So when the European debt crisis starts bursting, I do think strongly that the day of reckoning will come, and even though U.S. is a safe haven, the safest haven, I guess, at this point in time, will be called to task. So we'll see. So that's kind of where that is. So last Friday, Jan 13th, S&P downgraded 9 EU nations. There's a whole list, but the significant ones were France, Italy, and Spain. Besides France, there was another nation, I'm forgetting which one it was, which had AAA. So France and that one, AAA, got downgraded 1 notch. If I'm not mistaken, I think Italy and Spain both got downgraded 2 notches, which was quite significant. But the point here to note is that S&P so far, as I know, if I'm mistaken, please let me know. But as far as I know so far, in the recent past, S&P is the only one that has actually downgraded EU nations. Moody's and so people are keeping an eye on what's going to come out from Moody's and Fitch. I was reading somewhere, I'm not sure if it was Moody's or Fitch, one of them, or one of their analysts. I'm not sure how official that call is, but one of their analysts did come on and say, oh, absolutely not. We're not downgrading Italy at this point in time. So things like that, but something to keep an eye on. But the point here is, since last Friday, the French 10-year, even though France was downgraded, and I don't recall, they may not have done a fresh issue, but their bonds are traded on a daily basis, right? It's out there and it's being traded. So the French 10-year bond yields a little changed from 3.08%, from what I understand. Spain, and I believe one other, I'm forgetting which one, but the significant one being Spain, did its fresh bond issue, I think it was yesterday or the day before. And even though they'd lost two notches on the rating side from S&P on Friday, they were still able to sell their debt at half the interest rate of what they did a month ago before the S&P downgraded Spain 2 notches. So I think that's significant. I was very surprised. I didn't expect that. I still don't know why or how could Spain have issued its debt at such a low rate, even after it was downgraded. So that kind of brings me back to the subject today. So then does that mean that is it S&P rating agency that's losing its respect in the market? And I say respect because of that equation I showed you earlier, that generally when a rating agency, the god himself, announces a downgrade or bestows a downgrade to a nation, generally speaking, historically, the public or the investors tend to follow or obey because they respect a rating agency like S&P, like Moody's, like Fitch, to know what they're talking about. Okay, so that's kind of the background. So with what's happening at this point in time, there's a question in people's mind: is are rating agencies losing respect? So here's the interesting part, and I picked this up from Bloomberg. I'm sure if you go on other sources, you'll find it too. Oh, one thing before I forget, and I'll show you at the end, you should definitely keep also an eye on fxstreet.com's news section. If you go on the news, I believe there's Market Talk. I review it once in a while and see some very good articles or headlines there that I'm not able to find on other spots all the time. So keep that in mind as well. So so what I said earlier before I started this presentation, if I was, and I understand this again, I tremendously respect people like Mario Draghi or Mervyn King or Ben Bernanke. I think their jobs are very difficult. I would not like to do that job. I like taking challenges, but I think that's too much of a challenge under the current market conditions. But nonetheless, if I was them, I would make similar statements too. I would make most of this opportunity, and I would like to downplay or make, at least try and make my point is we should learn to do things without ratings or rating agencies, or at least we should learn to assess creditworthiness. So point well taken, but my opinion is that's a far road. It's not happening anywhere in the near future. Yeah, S&P may have lost a little respect in the market right now, but I think if Moody's, just one of them, not even both, if either Moody's or Fitch was to downgrade some of these EU nations, I think you'd see a significant drop. So I personally don't think their importance or the significance is lost. Likewise, Mervyn King said yesterday that markets have gone some way towards that where they pay less attention to rating agencies. So once again, I think they're trying to make most of the situation, and they're trying to downplay the rating agencies. So we'll see how far it goes. So I just wanted to kind of remind once again the slide that I kind of shared on the sovereign debt crisis presentation that I did a few weeks back. Italy, so this is the threshold, the 7% threshold. So when Greece, Ireland, and Portugal raised their bond, the 10-year bond at higher than 7%, they actually, I don't think it was the first time, so it has to happen consistently over a couple of months. I don't recall the exact dates or time periods here, but consistently, if they're not able to raise their 10-year debt below 7%, it's more than likely that nations, especially EU nations, would go for a bailout, right? Because they cannot afford to pay those kind of coupons or interest rate to the investors. So Italy, the point here, Italy, some of its 10 years issues, as you can see, spiked above the 7% mark even before the S&P downgraded last week. So keep that in mind. I'm also reminding once again that in 2012, overall, all the major economies in the world, the major ones at least, have to raise about 7.6 trillion of debt, and that's only the principal value of debt that's maturing. If I take coupon into account as well, the interest payments, it's about 8.3%. 8.3 trillion dollars worth of debt that's maturing in 2012. Now, as soon as I say debt is maturing, you have to automatically understand that they have to pay. Now, they have to pay if they have the money. If they don't have the money, what would they do? They would reissue new debt, and that's what you're seeing happening. So in order to reissue new debt, people have to buy that new debt. People have to believe in you, the nation. Now, if rating agencies, on the other hand, like S&P, come out and start downgrading a particular nation or a group of nations, guess what happens? The market confidence goes down. So, which is why Mervyn King and Mario Draghi, they're trying to make most of the situation. Once again, so just focusing on Europe, since we're focusing on the EU debt crisis, 1.1 trillion is due this year. Italy owes half of that. Just by March, Italy has to raise about 53 billion euros. And overall, Italy's debt is and that's a scary number. Italy's debt is overall 1.9 trillion dollars. So, I think just the last 2 or 3 days events of Spain being able to raise its debt at even lower rates, so on and so forth. I would not pay much attention to that personally. Okay. I don't want to talk through the slide again, but just to refresh your memories, this is a slide from McKinsey's report, and that just shows that the global financial stock, that includes your bonds and stock market and everything, peaked out at 2002. It dropped in 2008, and even though unemployment and everything else, what's happening, has not significantly gone up, but when it comes to stock markets, especially stock markets, and debt, they've significantly gone up. So they've actually broken their all-time high before the subprime crisis. They've gone to $212 trillion. So just a reminder. So what should we do? What should we watch out for? So in my opinion, you should watch out for the next shoe to drop. Now, before I even go through these points here, and these are some of the points that I could quickly scribble on the slide. Unfortunately, when the shoe drops, by the time the shoe drops and by the time you find out, it's normally already late. It's gone like 150 points, 100, 200 points, whatnot, depending on how big the shoe is and how steep the fall is. The sort of point here is, if you can get into before the shoe drops, if the pair is maxed out, if it has reached, if it has hit a decent support resistance or fib level, preferably a combination of support resistance and fib levels, along with a combination of the pair maxing out for the day or for the week or for the month, and it's retraced against the popular trend of a daily or a monthly chart. Those are the price points where you want to try and get in at decent points in time, and that's something we talk about more in our advanced syllabus on the 1000 Pip Club. There are certain moments in time that provide you good opportunities to get in. We call it the fundamental windows. So if you can get in that point in time, lock your trade, make it safe, and nobody knows. So, when what you call Merkel makes a statement, or generally statements come out, another word works. I don't think they tell people when I'm about to make a statement, unless it's on the calendar, unless there's a stated bond issue that's supposed to take place the next day or so. And I'm thinking of other instances where it's already out there, like interest rate announcements, so on and so forth. So that's again back to the calendar event. So anyways, in terms of the next shoe to drop, I think you should definitely keep an eye out on statements coming out from Fitch and Moody's, and actual downgrades, if at all. Now, if Fitch and Moody's don't downgrade and they actually somehow provide a clean bill of health to EU nations, which I don't know how they can do that, to be honest with you. But if they do, then you can continue to see some of these risk currencies continue long for a couple of days. But if any one of these, in my opinion, come up at a downgrade, for the downgrade of EU nations back up what S&P has done last Friday, I think you should see the risk currencies drop. You should definitely keep an eye on the upcoming bond issue by Italy, specifically Italy and Spain still, even though Spain did pretty good this week, and see if they are either undersubscribed. If undersubscription is also an issue. So this again is, if Italy did a 5 billion euro bond issue and it got significantly undersubscribed, like only 3 billion were bought, or 4 billion were bought. So that means there's not much appetite, and that again, you may see a risk off day. So essentially, risk currencies taking a drop. Either that, or them being able to raise their issue, raising what they subscribed for, but raising it at above 7%. That again becomes an issue. Greece not being able to negotiate its debt, so keep an eye on what's happening. The new prime minister, he's desperately trying to. So there was a deal, I think, done back sometime in October with the EU nations, and there were certain conditions laid out. Some debt swaps had to happen. There's a 50% haircut on the debt, which I'm hearing now. They're looking at more than 50%, even though the 50% was not. I think there were some clauses that he has to finalize, so it's not completely done. But in spite of that, I'm hearing recently that they want more than 50%, mainly led by Germany. They want more than 50%, from 32% to 30%. So over 70% cut they're looking at. And the point here is, as it is, 50% is difficult to negotiate if they're trying to go for a deeper cut. I don't know how successful they will be. He already has a very difficult situation, so to kind of fulfill. Let's see how he goes there. So keep an eye on Greece and what Greece does in terms of cutting down its debt. The other thing you might want to keep an eye on is a significant country like China or Germany dropping its growth forecast. So one of the reasons, besides Spain and the other country, the EU country, being able to raise its debt at low yields, the other reason why the Euro USD, the Aussie USD, the Kiwi USD, so the risk was off yesterday, was because China, I think it was yesterday before, because China came in with a positive outlook on their economy. Their economy improved versus the original forecast. And that's great news, right? Australia, for instance, depends, I think, something like 40%. I may have my numbers wrong here, by the way. But Australia depends a significant percentage on China for the GDP. So if China does well, typically Aussie does well, Australia does well, Aussie does well. That being said, in the morning, I kind of read a breaking news line on Bloomberg about Germany having concerns with its growth or GDP, something like that. So that could be a concern that you would see your risk assets drop just because of that news. Unemployment, jobless rates rising significantly or not reducing as required. Further austerity measures across the EU. So essentially, austerity measures would allow countries like Italy, Spain, Greece, whatnot, to cut on their debt. But unfortunately, what austerity also does is that it dampens growth. It reduces growth. So if you look at this equation, debt to GDP, you want to reduce the equation, but if I reduce the denominator, if I reduce the denominator, GDP, your ratio would still go up. So depending how fast you can reduce your debt and how much you can increase your GDP, that's really what you want to do. You want to reduce your debt and increase your GDP. But if you're reducing on a scale of 1 to 10, if you're reducing your GDP by a factor of 1, but because of austerity measures, you end up reducing your GDP by a factor of 3, you're worse off in debt to GDP. So keep that in mind. And especially Greece, if they don't meet the requirements of debt to GDP, they don't get the incremental funding. If they don't get the incremental funding, they default. The default, it's a ripple effect. Okay, so this is my last slide. All I want to point out again is when you look at charts, and if you believe that there's a downtrend, whatnot, you will never see any price chart, whether it's a monthly, whether it's a weekly, whether it's a daily, whether it's a 60-minute, or whether it's a 1 minute. I don't care. Or whether it's a tick chart. You will never see any price chart go in a straight line down or in a straight line up. It doesn't happen that way. There are always retracements, right? So what I've tried to depict here is the green going back up, and in a downtrend, the green line going back up is a retracement. And that happens. These retracements, you would typically find it peaking out at, and I probably should have drawn some lines here to highlight, but I was running short of time. So if you can imagine an imaginary line here, this is a better example. So this can come and hit this. And if you can imagine this as a daily chart or a 60-minute chart or a monthly chart, whatever. But this low here would be the 47.18 on the euro, and this could be 47.18 high. Or now, Sometimes it'll come into the pip and it'll kind of drop, but it doesn't happen all the time. And for those of you trading actively or trading for some time, know this. Especially if you're looking for a monthly chart or a daily chart, it won't come precisely at 47.18 or 28.57 under the current market conditions in the euro for instance. At 28.57, it won't come precisely 28.57 and go boom, bada bing, and go short. It won't do that. It might stop short 5 pips, it might go up 10 pips, but nonetheless, around there. Now, this is where Fibonacci's come a lot handy. So if I was looking at a chart like this, and I'm sorry if I'm not able to explain it very clearly, I should probably put some lines here, but I would be looking for fibs from here, from this top to this bottom here, and look if I get some nice 50% fibs here. If this was a peak, I'd be looking at a peak here and a low there, and see if I get some nice fibs lining up. So as this pair was coming back up, and imagine this being a daily chart, as this pair was coming up, if I'm getting 2 or 3 fibs on a daily or from a monthly chart, along with some nice support resistance levels lining up, and if over the day, during the fundamental window, whatnot, if this pair comes and hits a nice level, it's maxed out, that's a nice price point to take it, depending again on what's happening on the fundamental side in the market, right? Just to keep an eye on that. So the point I'm trying to make here is there are risk on days and there are risk off days, right? In the green, I'm trying to point out as risk off days. So on Friday, January 13th, I think this is the point where I start going into the charts. So before I go into charts, let me pull up and see if there's any questions. Am I still coming in? Am I still coming in, guys? Can you guys hear me? Can you guys still hear me? Just a quick yes, no, maybe. By the way, look at this. The euro has dropped, guys. Yeah. Euro has dropped. That's German. I think the German news on the GDP whatever growth issue has had some effect. Okay, let me get back on track here. So I wanted to share a little bit on Euro USD, a little bit on Aussie. But before I do that, I lost my chain of thought what was about to show. So there's something in here that I was talking about. Yeah, 28. Okay. Let's do this. Let's start with Aussie. Do we have Mark Knight in class today? Mark did the plan. I don't see him. That's fine. This will be recorded, so you can look at this later. Mark did a plan last week. Mark did a plan last week on Aussie USD, and I'm trying to first figure out the date and see if I can align this. This was Wednesday, and this is in Eastern time. By the way, the FXCM chart that I have is on the Eastern time zone. So last Wednesday was the 11th, 7 a.m. 11th, 7 a.m. So I should be looking for 11. So let me pick a line here, just a date stamp. 11 at 7 a.m. right around there. Okay, so if you can see that timestamp right there, and they may tell me if I have this right or wrong. This is around the time frame when Mark submitted his trade plan. It's still on the board. Guys, please feel free to go out and check it. So he was looking at taking this pair long at that point in time at 1.390. And he was also considering, thanks to me, and he was also considering, taking it short at 385. If I recall correctly, at that point in time, I felt more comfortable taking it short if it comes around those price points. Since then, it came at 376 once, went short. It came to 366, went short, and that was not until Sunday, 17th. Not until so on the 13th. Now this, once again, I believe this is around where you see these drops. You see these red candles on hourly chart. That's when around when if I recall correctly, this is around where what you call S&P downgraded the 9 EU nations, right? It happened around there. I think in the evening there was still some news on France that was coming out. So as soon as that came out, I guess it continued to further drop. Now, yesterday, Aussie, along with the euro, etc., went long, and that was, if I recall, there were 2 reasons for that. One was the Spain and the other EU nation doing well on the bond issues, and there was also the news about China doing better on its growth forecast. So I don't know the exact percent, 6 or 7%, something they said, they came far better. So both those 2 events caused to break 390. So the point I'm just trying to make here is when you see if I go back on the daily chart, and the reason market had picked up 390, first of all, was because it's in an uptrend. Aussie's in an uptrend. That's great. There is a nice resistance being formed here, as you can see. Further, if you look on the daily, you can see it clearly. You can see it on a monthly also. This candle low is 389, right there, 389. And I'm wondering if there were some fibs there or not. No, not really. But just based on that, he was looking at 390. So one thing I had suggested to him at that point in time was, if I go back to this candle here, was to avoid right around here where he was. I had suggested not to take the breakout in the next 12, 24, 48 hours. As it happens, to try and go for a breakout, it might head fake because the momentum may not be there to the maxed out, and there has to be something significant to allow it to break. That break happened yesterday, when, as I've been talking about today, in spite of the downgrade by S&P, the market did not respect that, and China's growth or GDP that came out better. So that was a huge spike. Now, would I personally still consider taking this long? No, I wouldn't. I'd be looking for, in spite of, I mean, that's just my mindset, and I leave it for you to trade as you want. But I would, generally speaking, there's bad news out there, and generally speaking, I don't know which shoe will drop next, but there's always a negative sentiment out there, generally speaking. So I'd be looking to take it short. So on the Aussie, in the next 24 hours, or depending on how far it's maxed out and whatnot, I'm looking at 1.05, and my basis on just from a daily chart is, if you look at this fib from top to low, there's a 76.4% lining up at, I think you can see this more clearly like this, hopefully, 1.0494. If you look at this high, this candle high, 499, right? And that being said, 1.05 even is a nice psychological level. So around there, if it extends and maxes out, that's kind of what I'm looking at this point in time. On the euro, actually I was able to get in the morning at I think it was 28.37. The basis here is this. So last week, I'm not sure if I did this on FX Street or if I did this on the Thousand Paper, I don't recall. But last week, these were the lows, right? 2660, 2664, so 2660 were the lows. So at 2660, if you did the fib, and I don't want to spoil my fibs here, but and this may not be precise, but if you went from here, this level, focus the top here, you will see it lines up at 2869, so 28,670 roughly. If you look at the other fib from right from here, somewhere, oops, right from here down to here, it lines up. Look at this top right there. It lines up 38.2% at 2868. And if you look at the third fib from this top right here, it lines up at 50% at 2868. So those are the three fibs, 23.6, 38, and 50, that lined up very nicely when this was below, right, on January 11th. At that point in time, there were two price points I was looking at, 2857, previous support, turn resistance, and the fib levels at around 2870. Look at what it did on the 13th. It went till 77 and then dropped. Now, at this point in time, I'm looking at 2840, just around where it is, 2840 and 2857. 2840 to 2857. Those are the levels I'm looking at. And of course, 2877 still remains a very strong price point. So it comes down to identifying price points. It comes down to knowing exactly how much is your account, what is your leverage, how much do you want to risk per trade, and trade management. So when I get in a trade, if it goes in my favor 25, 30 pips, we teach positional trading. I trade on a positional basis, but I make it safe as quickly as possible. Okay, and it comes down to everybody's mindset. So when it goes in my favor 25, 30 pips, I may take off 1/3 and put it at break even, or break even +1, or break even -1, or -5, whatever. So even if it comes back, hits that level, and more times than not, in the next hour or so, next 2-3 hours or so, it kind of comes and retests that level. And if you set your stop loss too close, it'll take you out. So that's what I'm looking at this point in time. And the rest of the lot you kind of ride as it goes. Generally, my feel on the euro is short. If I go back to my PowerPoint, this is what I'm trying to point out. There's retracements that happen, so you can almost see it here. See those retracements? Those are blue retracements. Retracement. Euro has retraced for the last 3 days. This is the third day it's retracing. It's already hit 2844. 2844. Let me take the slide up. 2844 is a very strong. So sorry, I didn't mention this. So now the fibs have changed. The highs are the same. My low has dropped down to 2624. Since my low has dropped, I would change my fibs. I changed my fibs, and based on that, if I extend, you can see 2841 is 23.6. 2842 is 38.2 from this high. Once again, 2841 is from this high. 2842 is 38.2 from this high. And 2840, I think it's 49. 2849, which is just below the 2857 level, is the 50% fib from this side. Now, this is not a 5-minute chart. This is not a 60-minute chart. This is a daily chart. Okay. That's what I have to share. So I'm almost done. There's 5 minutes left. I think I'm done for the day. Demi, thanks for responding to the questions. I'll take a quick look. Is there anything I can add on? Okay, so Demi, it seems like you answered all the questions, so I don't need to. And I'm almost run out of time. So thanks, Demi. Thanks, everyone. Thanks for attending these webinars. Once again, just reminding, the whole idea of these webinars are that you yourself make the effort and you submit a currency plan, any 28 pair, This is a wonderful opportunity. At least I'm telling you because I learned when I started back in 2006. That's how I learned. Make most of it. I know it's difficult. I know it can be overwhelming. It's easier to sit in class and listen to what I have to say, somebody else has to say. But if you want to learn Forex trading, especially if you're new, relatively new to intermediate level, and if you're having issues, make most of this. You can still learn listening to people like Mark Knight or some of the others who will step up, I can assure you. They will step up and they will do the plans. You can do that, but if you take the effort yourself and then hear out what myself or Demi has to say, or some of the others might have to say on your trade plan, I think you'll learn far more, far faster than somebody just sitting on the sideline. That being said, don't be afraid. You can be right or wrong, doesn't matter, as long as you make the effort. That's what counts. Thanks, everyone. See you next week.